Good afternoon, everyone. Thanks for watching. Today, I was going to do an update on a couple of questions that I got. I know that when I get the same question or two emailed and tweeted and people call the office, I know if a certain select group are thinking about something, usually it's pervasive among my audience. So I want to start with that. But before I do, let me say, thanks for watching for sure. If you like what you see, please give me a thumbs up on YouTube. So I think it was last week, I published a dedicated blog to my notion that there should be a recession in 2023. And I was surprised at how many comments, questions, and concerns I got. Yes, I'm still nursing that same cough I've had since I went to the 5th game of the Indians-Yankee series at Yankee Stadium, which was like 9 weeks ago. So I'm going to start with my comment about recession, and we'll morph it into a quick market update. So number one, as I've written for a while, the yield curve is inverted. And I want to be clear, some people scoff at the yield curve. I don't know why, because it's probably been the most accurate of all economic measures. But regardless of whether you like it or not, let me make sure everyone knows what the yield curve is. It is really simple. It's not wonky. It's the difference between two interest rates. So some people use the 10-year Treasury yield and the 2-year Treasury yield. You could use the 10-year and the 5-year, or the 30-year and the 5-year, or the 30-year and the 2-year. There's, I don't know, I didn't count how many combinations. I'm going to guess several dozen combinations. Some folks, so it's simply, again, sorry, it's the longer interest rate minus the short-term interest rate, long minus short. And that's simply because, think about it, if you're a banker, you borrow in the short term by paying people money market interest and CDs, and you lend long term. You lend 7, 10, 30-year mortgages a long term. So when a bank can borrow for a small interest rate and lend out at a much higher interest rate, they make the difference, which is called the spread. So if the 10-year was at 5% and the 2-year was at 2%, 5 minus 2 equals 3%. That's the bank's profit. In the best climate for the economy, you want the yield curve to be going up, and you want it to be very steep and wide. So in other words, you want the short-term interest rate to be much, much lower than the long-term interest rate. That's the best environment for the economy and banks, because it incentivizes banks to put more money on the street. Lend long, borrow short, make the spread. You're a banker. The converse, which is where we are today, is that long-term interest rates, the 30-year, the 10-year, they are lower than short-term interest rates. So as I look today, the 30-year is 3.4, the 10-year is 3.4, the 5-year is 3.6, which is higher, and the 2-year is 4.30. So if you're a banker and you borrow at the 2-year and you lend at the 10-year, you've lost a significant amount of money. You wouldn't do that. In other words, the banks, it's harder for banks to put money on the street to work when their yield curve is inverted, which is where it is today. The 90-day T-bill. So if you went to the government's monthly auction of 3-month T-bills, which are guaranteed by the full faith and credit of the US government, you're going to get 4.18% to give your money to the government for 90 days on an annualized basis. If you give your money to the government for 10 years, that's 3.4%. And that's because financial conditions are tighter. The Federal Reserve continues to raise rates, and there is not an incentive to put money to work. That's a very long-winded way of saying these conditions usually lead to recession. So let me share my screen. And show you. This is a chart I post on the blog all the time. The jagged one here is the 2-year note. It's at 4.34 today. And this kind of solid line is the interest rate the Federal Reserve controls, which is roughly 3.75%. The 2-year note is much better than any pompous, condescending member of the Federal Reserve. Sorry to say it like that, but that's how it is. I mean, you know how I feel. I think they flat out stink. What we know now is the 2-year is almost, and the Fed funds rate are almost together. When the Fed's done raising interest rates, the 2-year is going to curl down probably a little more than where it is today. We know in a week, the Fed's going to raise rates from 3.75 to 4.25. They're going to be almost equal. And now we're counting down until the Fed is done raising rates. So now you know where the Fed is. The 2-year was at 0. Now it's at 4 and change. Let's go to the yield curve, which I just talked about. Most people look at 10-year minus 2-year. Here it is. So this blue line means the yield curve is flat. Below the blue line, it's inverted. Above the blue line means it's steep. So you'll see since early July, the 10 minus 2 has been negative. And look, it's now down to 0.8%. That makes it very difficult for banks to lend. And that usually signals recession. I personally like to use the 3-month and the 10-year. So it just inverted in October, and now it inverted super quickly and steeply so at minus 0.86%. That's not the final nail in the coffin, but this tells you that recession is looming. It's not a good timing indicator. So just because the yield curve inverts doesn't mean recession is here now. In 1998, it inverted, I think it was 98. I don't know, it was over a year before recession hit. In 2000 and, scratch that. That 98 analogy was 100% wrong. I was talking about a different indicator. In 2008, the yield curve inverted in 2006. So it's not timely, but it is accurate. It just tells you the countdown has started towards recession. What's left standing? What's the odd man left standing? Last man standing, last domino? We know this. I wrote about it last week. The jobs market is still super strong. Unemployment's only 3.7%. Last month, the economy created 268,000 new jobs. Now, yes, you're going to push back and say, well, employment is the most lagging indicator of all. And I agree with you. It is. But it's the only man standing, or the last man standing. So once the employment domino falls, that's when the recession likely begins. I fought people all year long saying recession would not come in 2022. I'm sticking by it. But I think it is coming in 2023. I think it probably starts in the second quarter, but that's probably putting too much of a fine point on it. I don't know. Now, given that recession, I think recession's coming next year. Should we harvest our acorns, get into a bomb shelter for the stock market and the at-risk markets? And the short answer is right now, we simply do not know. I'm going to give you 3 scenarios for next year. Before I do that, let me say this. The stock market was down 25% at its low, S&P. NASDAQ was down 40. The markets didn't go down because the economy was hunky-dory. Markets went down because inflation was rising, because the Fed was doing what they're doing, and that was going to lead to weaker economic times. If we have, okay, so there is a chance that the decline we saw from January 4th through October 13th already discounted the mild recession. That's a logical scenario. Let's go to the 3 scenarios. So 1, let's say there's no recession at all. The Fed threads the needle, inflation continues lower, we don't have recession, and the economy re-energizes itself at some point in 2023, and inflation doesn't go crazy. In that regard, which I don't view as likely, but if that's the case, I'll tell you stocks are going to go up 20 to 30% next year. Bonds go up 5%-ish, no recession. My base case is that there's a mild recession, and most of what we saw in 2022 has already discounted it. In a mild recession, bond market gives you 5 to 10% upside next year, and stocks give you 15 to 20% upside next year. And thirdly, let's say I'm wrong and the recession is not mild, the recession is more moderate to severe, which I do not think is the case, but I've been wrong before, I'll be wrong again. If that's the case, then I think stocks go up 5 to 8%, bonds go up 10 to 15%. So now someone or many of you are going to tweet or email or call and say, but you just gave 3 scenarios. All 3 have stocks and bonds higher next year. Yes, that's what I believe. I think next year is an up year. Yes, I know about Russia and Ukraine. Yes, I know about inflation. Yes, I know about recession. But I do think next year is an up year in the markets. The path from Jan 1 to December 31 will differ greatly. If we have this more serious recession, deeper recession, if you will, then the first quarter or perhaps the first half of the year are going to be bumpy and rocky, and there will be more downside in especially stocks first 3 months ish. In that case, I'd argue that the ultimate low in stocks comes in March. A little higher, a little lower than what we saw in October. And then we regain what we lost, and then we end up 5 to 8% higher. That's the bumpiest scenario for next year. Excuse me, this has got to be annoying to you as it is to me, and my wife's going to kill me at this point. If there's no recession and inflation doesn't spiral back up, it's going to be a year like 2021, 2019, 2017, 1995, where the market doesn't have any pullback of 10% or more. Every bit of weakness can be bought in that scenario. So those are my 3 scenarios. On what's today's date? On 12/7, I don't have conviction on which one I feel the best. Oh, that's not true. I think the middle scenario is the most likely right now. Mild recession and stocks go up 15 to 20% next year. But the path, I think, is still up in the air. A couple of things would change my opinions. One, if the Fed stopped tightening by selling their assets. Every month, the Fed's selling $90 billion of securities. If the Fed tapered that from 90 to 50 or 40, that'd make me more positive. If the Fed tapered that to 0, I'd get even more positive. That's a long way away. Let's not go there yet. I think how next year goes is going to depend a lot on what happens with first quarter. No, with fourth quarter earnings, which will be announced in the first quarter. I'm going to have plenty of comments about that going forward, but that's a big determining factor. So yes, I do think we're having recession. Oh, I should stop sharing the screen so you can look back at my ugly mug. The yield curve certainly says so. The leading economic indicators tell you that recession is coming. We'll wait and see on jobs if they actually roll over like I think they will in the first quarter. But perhaps they don't. Perhaps the Fed threads the needle. Perhaps we get the Goldilocks scenario and this elusive soft landing, which would be like landing a 747 on an aircraft carrier. Wouldn't be so easy. So let me finish up with some comments in the short term about the markets. So last week, during Jay Powell's interview at the Brookings Institute, I think it was, with David Wessel, he just reiterated some common held thoughts that they're going to raise rates 0.5% in December, not 0.75%. Stocks went insanely higher, up 1,000 points in the Dow, and it looked like it was 1999 again. Everybody was partying, blowing the Happy New Year, groggers and noisemakers, etc. And then we've given back all that gain since. Sentiment has quickly shifted to, holy geez, things are really bad. What's going on? Bear market's reasserting itself. So we are in this seasonally soft period that started last week and will go, look at my calendar, it goes between the 12th and this year and the 12th and the 21st. So the market is supposed to bottom between the 12th and the 21st and then rally into January. Just because it's supposed to doesn't mean it has to. In 2018, we bottomed on Christmas Eve. We sold off sharply into Christmas Eve. That wasn't fun. Then we did rally from the 26th into the new year. In 2007, we got a bunch of lumps in our coal in our stockings, if you feel sorry about that. And the market did not fare well into year end. And there are other years too. I didn't pull up my stats, which I will as we get closer. So market's rocky right now. I wouldn't be surprised if we saw some more mild weakness into next week. Then the market kind of gathers itself, firms, and rallies into the new year. I do not see a repeat of last year where we peaked the second trading day of this year, sorry. And then they just cut them loose. I don't sense that's going to be the case again. So there's my view. I tweeted it and I commented on the blog. In November, we bought more bonds, cash bonds, corporates, munis, and taxable munis than at any time, I think, since March of 2009. So you know what I feel about bonds. I think bonds offer the best risk reward for next year of any asset out there. But I don't think bonds are going to outperform. They probably won't outperform stocks, but the risk reward, because I think you don't have a huge downside risk in bonds unless inflation literally re-energized itself. I think inflation's peaked. But if you say to me, where could you make the most money next year? I think it's in the stock market, but you're risking more. So it's again, risk and reward work hand in hand. But I do think the bond market on a purely risk reward basis offers a super opportunity into, clearly into year end, because I bought all these bonds in November now, and then in 2023. So with that, I will say thank you so much for watching. If you like it, please give me a thumbs up. I'll be back to you on the blog actively into year end. I hope all's well. I'll say this a number of times. I hope you have an awesome holiday season. Everyone's usually, many people are hugely happy this time of the year. So if you started your holiday season already, I hope you're having a great holiday season, and we'll be back with you soon. Bye-bye.